Hi, I'm David Scranton, and thank you for clicking this video because today we're talking about the biggest economic story of the year, and of course, that's inflation. It's been slightly over a year now that prices have been on the rise, and the Fed is trying to battle inflation, but it seems to be increasing the fear factor among economists and everyday investors of the creation of a possible impending recession. And to talk more about this, let's bring in Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, as usual, always great to see you.
It's so great to be here, Dave.
And I know you're excited because one of your favorite guests is here today, and that is our special guest, Steve Forbes, editor-in-chief of Forbes magazine, and also author of the new book, Inflation: What It Is, Why It's Bad, and How to Fix It. Steve Forbes, thanks so much for being with us here on The Income Generation.
Good to be with you. Thank you for having me on.
Wow, what a great topic, Steve, inflation. The Fed finally did it. They did $7 trillion of stimulus in 2020, both fiscally and monetarily, and boom, inflation was created, and you wrote a book about it. Now what's going to happen?
Well, what's happening is that the Federal Reserve finally realizes they have a disease on their hands. They got a real crisis on their hands after pretending for a year and a half that it's just going to go away. The amazing thing is, and we point this out in the book, which is written in a very friendly, jargon-free manner, is that last year the Fed, even though the economy is beginning to recover from the COVID lockdowns, the Fed still continued to print and create a lot of money. $120 billion of bond buying a month. How did they pay for those bonds? They paid for the money created out of thin air. Right. So now, as they say, the chickens are coming home to roost, and the Fed laid a big egg, and now it's scrambling to undo it. But I'm afraid they think the way you fight inflation is by depressing the economy. So I'm worried about an economic slowdown. These guys are guilty of economic malpractice.
Steve, it's interesting because, first of all, I want to know how long ago you and your co-authors planned the book, because that shows some really good foresight on your part, and why you thought it was so different this time that you needed to get together and write such a book.
Well, we started it a little over a year ago. I got the manuscript in the fall, but you know how book publishing is. It takes a while to go from manuscript to hardbound book in the bookstore or online. And so it was clear, we thought a year ago, that when the Federal Reserve was going to continue this bond buying, that there was going to be trouble. You know, we point out there are two kinds of inflation: non-monetary inflation, which comes, say, you have bad weather, so you get a crops going up in price and that kind of thing, or a war like we're seeing in Ukraine, or the kind of lockdowns that they did during COVID, which severely disrupted supply chains all around the world and raised prices. But then you have the monetary kind, which the Fed can control directly. Even before COVID, David, the Federal Reserve was undermining the dollar. They were creating too much money, 2018, 2019. And they continued it in 2021. The government was spending like crazy, and the Fed was financing much of that debt. The Fed was an enabler. Now we're all paying the price for it.
No doubt about that, Steve. I'll tell you what, though, the Fed finally did it, so hats off to them on creating massive inflation, the worst inflation in history. It's impossible to inject $7 trillion into a $20 trillion economy and not expect rapid inflation, high employment, high consumerism. But they've set us up for a ginormous fall. Are we going to see a recession now because of all of this overstimulation?
Well, unfortunately, the way the Fed fights inflation is we're going to have a more economic pain. They are going to make the situation worse. The Fed believes that inflation is caused by too much economic activity. And so even though they don't say it, when they use words like, we want a soft landing, that is Fed speak for, we hope to slow the economy without too severe a downturn. But usually soft landings turn into crash landings. And so if I had more faith that the Fed knew what they're doing, I'd say we could get through this in pretty good shape. But I have no faith in the Fed at all. And they've done for what they've been doing so far. They raise interest rates, which is going to hurt the housing market and other things. At the same time, they're hurting the economy. You know, one of the best ways you fight inflation, which Reagan did, is you have a vibrant economy. And that comes from less regulation, lower taxes, and lower spending. which this government is doing the exact opposite on all fronts.
Yeah, I agree that the government itself is not doing a lot. They've kind of left the Fed stand alone in trying to deal with the inflation issue. And at the end of the day, it's not the Fed's fault because the Fed, well, it could be the Fed's fault because they acted too late, you can argue, but the Fed only has one tool, and that is interest rates to taper down demand. They don't really have a tool for the supply side of it, right? That's really up to Congress, is it not?
That's right. And on the Fed side, what they are doing is as you know, banks are now loaded, drowning in reserves. And so what I think what you're going to see the Fed do is start to raise the interest they pay on bank reserves on deposit at the Fed to try to keep some of this mounds of money from flooding into the economy. And it's very interesting in terms of the games these people play. You know, the key thing that economists look at for money supply in the economy is what they call M2. That used to come out weekly. Now that number comes out monthly. What do you think of that? Trying to suppress information.
Sure.
Not to be unserious about it, Steve, but I guess having faith in the Fed is like believing you're going to get honest news from CNN. And on that note, I pulled an article from CNN back in 2000, after the first quarter, when the dot-com bust still just started to happen. And they were glamorizing how earnings were going to be really robust and everything was going to be great at that time. I feel like we're in a 2000 moment all over again, but we're in 2022. And now we're at the start of the great unwind in asset prices. Give us your thoughts in that regard. Are we in the same position as we were in 2000?
Well, we're in the position in 2000 where we've had a very vibrant market, as you point out. And now we're in a situation where both stocks and bonds are in trouble. Bonds, obviously, with rising interest rates, that means the price of existing bonds go down. And in terms of the stock market, yes, I think the market's upside potential is, shall we say, limited. And I fear a downturn. And again, the way you fight those things is you stabilize the value of the dollar and you make it easier for people to do business with one another. You know, what's amazing is the energy in this economy. You feel it in a free state like Florida, and people want to do things. And that's the way you cure these things. You know, after the terrible inflation of the 70s and early 80s, we had a great 20-year boom until government wrecked it again.
Well, and of course, as you indicated before, one of the things Congress can do is have fewer regulations when it comes to energy, which would help us a lot right now when it comes to inflation. But the Federal Reserve can't control what Congress is going to do or what the White House is going to do. So what do you think the Federal Reserve should be doing with interest rates right now? Should they just...
What they should be doing is nothing. Let the markets set interest rates. It's amazing we all sort of accept that the Fed should have the equivalent of rent control on money. You know, we call it borrowing money, but it's really renting money, and the Fed is putting price controls on it, which distorts the markets. We know that in the housing sector, less construction when you have rent controls, and the Fed is doing the same thing. So they should just let the markets, let borrowers and lenders settle on what the rent for the money should be. In terms of the Fed's balance sheet, they're bloated holdings. When a bond comes due, don't buy another bond, let that unwind, and they should then focus on the dollar, stabilizing the value of the dollar. And then they'll minimize the harm that's done to the economy. But I fear they're going to try to engineer a slowdown. And the idea you can control an economy of 330 million people by a handful of bureaucrats at the Federal Reserve is just so preposterous, it leaves me speechless almost.
Well, on the economy, Steve, things are starting to slow down. We're starting to see that, you know, and so where do we see the inflation tapering off? Because we know we're at 40-year highs for inflation. Things are priced to perfection right now, especially in the real estate realm. And are we going to see demand destruction, or are we going to see inflation kind of pull itself back in check before we see that demand destruction?
Well, that's in the hands, that's sadly out of our hands. We'd know how to fix it. But in terms of the Federal Reserve, they should not be trying to manipulate interest rates. Let the economy determine the amount of money it needs and meet those needs and no more. And we used to have a gold standard which worked very well despite what the myths of today. But even in the 1980s, late 80s, early 90s, Alan Greenspan sort of pegged the dollar informally, very informally, to gold or a basket of commodities. So that way you have some stability out there and let the economy take care of itself. And one of the things I'm hoping for after the November elections, if not before, is that Congress will take a very active role in rolling back regulations or not financing the government's obstruction of the economy. For example, they ballyhoo this great infrastructure bill, which is, only 10 cents on the dollar on that bill was for actual roads and things like that. But no sooner was that bill passed than the Biden administration reimposed rules in terms of environmental rules and other regulations that are going to delay these infrastructure projects, tie them up in thousands of pages of studies and things like that. So they say they love infrastructure, they just don't want you to do it.
So, Steve, final thoughts. As a member of the income generation, what best, obviously you think that there's a high likelihood the Fed will create a recession of sorts. We tend to agree. So what's your average income generation member to do with their money to protect themselves? What's your best advice?
I would keep a portion of your money, not a lot, but a portion in gold, not as an investment, but as an insurance policy. I would look for stocks that have a good record of dividends and being able to raise prices. So you get income that even might rise during a troubled time. And bonds, I would stay away from long bonds. I think those rates are going to go up some more. And you get a feel for it. Look at the 2-year Treasury, which a few months ago was basis points. Now it's over to 2.5%. So I would be very careful there. Keep your horizon short. But the thing is, I think in the next 2 years, both with these elections and the 2024 elections, we're going to have a situation like 1980. We're going to set the groundwork for another zoom upward. When that happens, the economy will take off like an Elon Musk rocket. But in the meantime, have your hedges like in gold, stay short on bonds, look for good dividend stocks that have a solid history and solid cash flows.
Jeff Small, Steve Forbes, thanks so much for being with us here on The Income Generation.
Thank you.
Thank you, Dave. Thank you, Steve.
Thank you for watching today's video, The Inflation Situation. If you liked it, give us a thumbs up by clicking the button, and you'll essentially give us a like to make sure that you subscribe to our YouTube channel for new content each and every week.